Okay, I'm recording. So I'm Angelique Andrea. I'm a realtor with Weichert in our Aspen Hill, Maryland office. And I'm here today with Chris Caponiti, our mortgage advisor from our office. Hi, Chris.
Hello, good morning, or still morning. Good
Yeah.
morning.
So we are here today to try and demystify the lending process a little bit. So I've got some questions for Chris that I get from people quite often, and he's going to answer those for us. We are in interesting times right now. This is June 10th, 2020. And if we're talking about interest rates or anything like that, those are things that change all the time. So if you're watching this in October of 2020, some of that information might be out of date. But for the most part, this should still apply. So thank you, Chris, for being with me today. I really appreciate it. And I'm just going to jump right into our questions.
All right, go ahead.
So one question I get from a lot of people is they think I can't buy a house until I've saved up 20% of my sales price to put down. Is that the case?
There are many ways to buy a home with a lot less than 20%. Conventional loan, which is the standard type of loan that has always been, a 20% down payment, can be done with a 15%, 10%, 5%, or even 3%. And that's done with something called mortgage insurance. And basically the lender, in this case me, or perhaps a first-time home buyer program, is insuring the loan. A private company will insure the loan for the lender against default. And that's why you can put down less money. It's called private mortgage insurance. And it is driven by your credit score. So the higher the credit score is, the less expensive the mortgage insurance will be.
Oh, interesting. And speaking of credit, what does my credit score have to be to buy a house? Do I have to have a 780 or?
Okay, well, let's say, so if you're going to do a conventional loan, I believe that our minimum right now is a 620. But keep in mind that if you're doing a conventional loan, a 620 is probably going to require at least a 10% down payment. Again, it's going to be, as the score goes lower, they're going to expect more of you. Maybe a lower debt to income ratio, which is all of your debts put together against the income that you make. Okay. So as your credit score goes down, the requirements will get tougher. As your credit score goes up, if you have a 740 credit score, you can do 3% down, no problem. Now, this is for a regular conventional loan. There are other types. So if you've heard of an FHA loan, which is a federally insured low down payment loan that anybody can get. Now, those tend to have lower credit requirements. Right now, due to what's going on in the world, a lot of lenders have tightened up the requirements, but generally, I think you can go down to 580. We used to go down to 580 until the current environment. We suspended that program. And some of the first-time homebuyer programs will have 640 as their benchmark. I believe ours today is a 620. Okay. So that's a federally insured loan where the mortgage insurance is a set amount, no matter what your credit score is. Okay. Well, you say, why would I choose that? Basically, if you're in between a 580 or a 620 and 700, FHA is probably going to be the best option because, like I was saying before, where the mortgage insurance is tied to your credit score, the mortgage insurance will get so expensive with a conventional loan that you would opt for the FHA loan. Then on top of it, FHA rates tend to be slightly cheaper. Why? Because the federal government is insuring the loan. It seems like something that is a little less risky than a private insurance loan, for example.
Okay. So all of these loan programs can feel a little bit like alphabet soup for people. You hearing, FHA, and there's VA, and there's,
Correct.
so if we can
And
run through sort of some of those different loan programs. We were just talking about FHA loans. Those don't work in every situation, though. Uh, the home has to be uh, able to.
right, the FHA process is a little bit tougher. There's a few specific things that I assume I guess the seller has to agree to the contract where your agent is presenting an FHA loan, and they have to agree to it. Generally, it's not a problem, but if the home has specific issues that the seller knows about, not things they haven't disclosed, but things that they know about and you know about, they're going to be less likely, such as if the home is built before 1978 and has any kind of peeling paint, it will be flagged. If it has a crack in any window anywhere, that will be flagged. If it has anything that is unsafe, if the basement shows any signs of water damage, that would be another issue. They will also inspect. They will actually go up into the rafters, up into the roof, and inspect and make sure there's no evidence of leaking. And if there is anything that's fresh, then they're going to ask for that to be remediated. So this is what the seller is getting into when they agree to do an FHA loan. So again, rarely is there a problem. If the home is in good order, generally it's okay. But if you have an older home, you can have a laundry list of things that need to be repaired. I've seen everything. I feel like I've seen everything in my career for repairs for an FHA loan. Now, another thing is with an FHA loan, they also are part of the first-time homebuyer programs, such as there's one in Montgomery County, which is where I'm based. So obviously I take part in that one. And then there's one that's statewide that is for anywhere in the state of Maryland. We also have one for Virginia. And they're all a little bit different. But basically, they are giving you either a grant or a deferred no interest loan to help with closing costs and down payment, or both, depending on what you need. They tend to be strings attached, meaning your rate is a little bit higher, or you pay it back in the future, or you're stuck in it sort of for 5 years. You can't get out without paying it off, let's say, for 5 years, and then it's forgiven. But again, you're paying a higher rate. So you're essentially just paying back the person that gave you the money, the state or the county. Those programs have conventional loans, and they also have FHA loans. So the same rules apply. You would just pay, maybe an extra fee to them for that program. And it has to be it's underwritten by the lender, and then it's given to HOC or CDA, and they have to sign off on it. So the process is a little bit longer. You have to be prepared for an extra 10 days or so, because once the loan is out of our hands, we're sort of at their mercy for timing. So you have to be ready to have a longer settlement date. So tough. If you're in a real rush, it's tough to use one of those programs. You can't have owned a home in the past 3 years. So a lot of people think that first-time homebuyer means they never owned a home, period. It doesn't mean that at all. It just means you have not been on title to any home anywhere for 3 years. And there's a lot of people that are in that situation. You could have been married and got divorced and sold a home, and you've been renting for 3 years. You could have owned a home for yourself more than 3 years ago. You could have, had a home go into short sale or foreclosure back in 2008. And of course, you're eligible today. I've seen, again, for this, I've seen everything also. Right. Every type of buyer.
Okay, great. And if I'm buying a condo, the condo complex itself has to be FHA approved.
That is correct. However, recently FHA put back into effect the means to do what's called a spot approval.
Oh.
So even if the development has not usually the management company will stay on top of the approval. Why? Because the more buyers you have for your development, the better the market is going to be for all the people that own it. So they obviously are for it.
Right.
So most of the places will stay on top of it and do it themselves, and they'll make sure they stay on top of it. But who knows? You might get the wrong management company. They might let it expire, not really understanding or not opening them. Who knows? Who knows what the reason is? Maybe you hired some really cheap management company to save some money and they let it lapse. As long as you meet the requirements, and of course, if it was approved before, we know that they did meet the requirements, you can ask for what's called a spot approval, where you just approve it on the spot based on the numbers. It has to do with the number of units that are delinquent, the number of units that might be rentals. The concentration of rentals and the delinquency rate are the two main factors that will affect FHA approval.
Okay.
So now you can get it. So yes, generally you have to be approved, but now there is a way to get spot approval. It doesn't feel as good because you're going into it with the uncertainty and not know. You'd rather find a unit that is approved.
Right.
Naturally.
Well, that's good to know. I didn't know about the spot approvals. Ran into that situation once last year with a buyer who she had her FHA approval, and then the building something happened where when they filed their paperwork, they were off on the number of units.
Ooh, yes.
Like 2, and so the government sent their paperwork back to them and said, you need to correct this. So they were in this lapsed time period, and she couldn't get an FHA loan for the condo because of that at that time. So now I guess she would have been able to get a spot approval.
Now, absolutely, you'd be able to get a spot approval, but I guess you never know for sure whether that's going to come through.
Right.
That's the tricky part.
Yeah.
There are also overlays with a conventional loan. So it's not only FHA that has the difficulty. You have to meet certain requirements for an FHA loan. For a conventional loan. So if you're doing a 3% conventional loan, the place has to meet every time you do a conventional loan. It is a spot approval. Okay. Spot approval every time. There is no set Fannie Mae approval list or a Freddie Mac approval list. It's always a spot approval. So they send what's called a questionnaire, and they answer the questions, and it's approved based on that. Now, if you put down 10%, the questionnaire is pretty easy.
Right.
If you put down less than 10%, the questionnaire is a little bit tougher. So I've had 2 deals, I guess 2 times in my career, I've had a deal fall apart because of a problem with a conventional condo that wasn't, approved. So the only way to get past it is to put down 10%.
Got it.
I think the person ended up finding a way to get a gift from somebody and ended up completing the transaction. But it's tough. That's a tough situation.
Right.
Yeah.
So conventional is sort of the standard way everyone, that's open to everyone.
Correct.
Like as long as you can meet the credit requirements. FHA could have some strings attached. The home has to.
The home, but then there's another thing. So FHA is easier if, let's say, you had a bankruptcy or a foreclosure. That's going to be the easiest way for you to get back into the market. So that's the plus. Okay. So that's why people would use them. You can always get a conventional loan if you can have a 620 credit score. You can always get a conventional loan. There's a program called Home Ready. There's a program called Home Possible that are, again, 3% down. They're going to require, it's going to depend on your unique situation. I can't say exactly who's going to be approved and who isn't, but there is a way to do a conventional with 3% down with a fairly low credit score. And that program has an income limit. That's the most important thing, but the rates are fantastic. And they don't have what's called upfront mortgage insurance premium, which is, to me, the biggest drawback of an FHA loan is an upfront fee that you pay that gets rolled into the loan.
Got it.
And there's nothing, it's gone. I mean, basically, you put down 3.5%, but you're really only putting down 2%.
Yeah.
And it's gone. If you go to refinance in 5 years, your equity position is going to be less. Now, if you got a better interest rate because you went FHA, then hey, down the road at some point, the two will converge and it's not as bad. But in the short run, you're moving in and you're not in as good a cash position as you would be with the same conventional loan or a home ready loan. Again, every single zip code has a different income limit. So Montgomery County has a higher income limit than Howard County because Howard County is part of Baltimore's metropolitan area, and their limits are lower.
Okay.
But around here, every county is the same. All the counties that touch DC have the same. I believe it's 96,000. And unlike a first-time home buyer program, if you're going to get into a first-time home buyer program, every single person involved in the transaction, boyfriend, girlfriend, husband, wife, whatever it is, has to be on the application and has to declare their income. And you have to be underneath their limits. Now, their limits are higher. The limits are higher for couples, for first-time home buyer. They're in the mid 100,000s. So it doesn't exclude too many people,
Right.
but everybody has to disclose. With home ready, if you have two strong borrowers, you only need to qualify with one person. And the other person will not disqualify you or push you over the income limit. So
Yeah.
that's important.
Right. Yeah, 96,000 doesn't feel like a lot in this area.
Right.
Combined. Yeah. So let's talk about VA loans a little bit. I'm a vet myself. I used a VA loan to buy my current home.
Okay.
It's fantastic. But VA loans are wonderful, but they also have a drawback of the upfront fee. So.
Right. There's an upfront fee, which is significant. It's 2.3% today for first time use. Now, if you put down, and that's for 0% down. Now, if you put down 5% or 10%, it drops. There's no monthly mortgage insurance though. So a VA loan is still the best thing around, dollar for dollar. The rates are, again, really good because it's insured by the government again, essentially through this funding fee. But you only pay the one fee one time.
Right.
And the rates are good. Now, if you are a disabled veteran, I believe if you're 100% disabled on paper, you do not pay the funding fee.
Right.
Yeah, so that's waived.
Yeah.
But VA is the best loan around. And the state of Maryland program with the assistance, down payment and or closing cost assistance, VA is part of that. So there is a VA program in there, whereas for the Montgomery County program, there is not.
Got it. Okay.
So if somebody was VA and they wanted to put nothing down, roll in the funding fee, but they don't have the closing costs, you can get the closing costs for the program and have absolutely zero out of pocket.
Oh wow, that's fantastic. And using your VA loan, unless you are in a situation where that fee can get waived, using it a second time gets really expensive.
More, it's 3.3% the
Yeah.
second. And it might be 3.5 now. I don't do many of those.
Right.
Or haven't had customers that had that issue. But at that point, I don't want to say it never happens. It is rare because you're talking about somebody that owned a home before. Hopefully they've got some kind of equity. If you have any kind of equity, then why would you want to pay 3.3% up front if you could just put down 5% conventional, preferably more. But that's a big number to overcome.
Right.
That's 3.3. Yeah, that's a big number to overcome.
Right.
To roll into your loan, you're starting off with a tremendous amount of negative equity.
Yeah. Okay, so that's conventional, FHA, VA. Are there others? I can't think of any, but
well, there's USDA, which is tends to be for rural properties, and there is a map. You can Google it. It's USDA eligibility map, and it just brings a map up. You type in the address, so that you can't just say, oh yeah, you can buy a house. It depends on where it is. Now, of course, there are certain areas where you look on the map and it's all green, so it means it would work no matter what you bought in that area. But generally, there are squiggly lines that go in and out of more. I believe like Hagerstown, Maryland, for example. It's a rural community, but there is a city center. I believe in the city center, you can't get a USDA loan, but outside you can. something like that. So you
Right.
have to type in the address
And
and
what's the
see what it is.
advantage of a
A
USDA?
USD loan is also a zero down loan.
Okay.
Yeah,
Wonderful.
yeah.
Good.
But again, it's only for, but it is tougher to qualify for.
Okay.
Okay. So a lot tougher to qualify for USDA loan than a VA loan or an FHA loan, which have the loosest debt to income standards. USDA has the tightest.
Okay. Good to know. Can we talk a little bit more about PMI? I've seen where people have pretty high monthly PMI payments. I've also seen where PMI has kind of been rolled into the loan, so
Right.
the
You can do PMI any number of ways. You can do what's called a flat fee up front, like we were talking about the VA having their own funding fee, PMI, whatever.
right.
You can pay it in a lump sum up front. Let's say you had a lot of cash and you want your payment to be as low as it can. You don't want the MI. You have enough cash to put down the 5% or the 3% and pay your closing costs and maybe a little bit more, but you'd like to buy your payment down. So you could pay a one-time fee for the PMI, and that is completely driven by how much you put down and what your credit score is. I can look it up very quickly on a couple of different websites and see what it would be. You just plug in the credit score, the number of borrowers, the percentage down, and it throws out a number.
Okay.
You can do what's called a hybrid, where you pay a lump up front and a smaller amount per month, or you can pay just monthly, which is what most people do.
Right.
The problem that I have with paying up front is, let's say, you're anybody that got a loan in the past, I guess when the rates violently came down was about 2009, where they sort of violently came down from about 6% to about 4%, and have kind of been between 3 and 5 ever since. So anybody that paid a lump sum for MI, the money's gone. You can refinance the loan, but the money's gone. So if you chose monthly insurance, it's just a monthly fee. So you could have refinanced and not lost that money. Whereas if you pay $7,000 up front at 3 3/4 and the rate goes down to 3 1/4 and you want to refinance, well, you lost the $7,000. That's a lot of money to overcome. So I have never encouraged, I know people that really like it. I have never encouraged that to my customers because of the environment that we're in sort of a downward interest rate environment. And I don't know what is going to change that with the way the economy is right now and what's sort of on the horizon. I actually saw last night a well-known bank predicting. It was a very strange article. I'm very leery of anything that I read in the financial media because I've been covering it so closely for a long time, and I see how often they're wrong, that it seems like it's purposeful. Because why would anybody ever tell you anything to benefit you? They don't. They do. Oh, people are always self-serving. They do what's going to benefit them. So I feel like the financial media is no exception, and they will say things that are just not accurate. So they said, oh, well, I see 10-year yields going to 1.5% in the short run. Sorry, it's my home phone.
Okay.
Going to 1.5% in the short run, which would translate into rates, going back up around, let's say 4%. But it didn't say when or whether it would stay there. It was strangely written.
Right.
I thought it was just a way for somebody to get a couple people to buy it, and then they would just sell into the I'm very cynical about that stuff. But I haven't seen anybody really predicting rates to go up, and that was kind of an outlier. That article that I just read, it was last night. So we're still in a low interest rate environment, so I wouldn't want to encourage anybody to pay lump sums that they're going to lose, because usually the break even is years and years down the road where you break even.
Mm-hmm.
Well, I've personally never held a loan for more than 2 years, just because rates just keep ticking down.
Right.
So again, you can do what you want. I'll present the information and you can choose for yourself, but I just don't encourage that.
Right. Okay. Another question I get quite often from people is in regard to closing costs. Is there kind of a, a general formula, like closing costs are typically 3 to
Sure.
5%, or
Okay, so closing costs, you've got certain things that are flat fee, and then you've got things that depend on the size of the loan. So of course, as the loan gets bigger, the percentages get smaller, or as the purchase price gets bigger, the percentages get smaller. As the purchase price goes down, the percentages get larger. So if you have a set lender fee of $1,100, whether or not your loan is 100,000, well, that's like 1%. If it's 500,000, hey, it's only 0.2%. So then you have, your settlement fee for your attorney to sit down with you. He's sitting down with you whether or not you're doing a $100,000 loan or a $500,000 loan. So there are certain things that are flat, but then there are transfer taxes that are driven on the price of the home that you pay. You pay the county, and you pay the state, and you pay recordation tax, slightly different in each county, but that is something that's driven on the purchase price of the home and tends to get more expensive as the home, that's actually new, that they've made it even more aggressive to get more expensive as the home gets more expensive. So that's one of the things that would counter it, but it's still not enough because their appraisal fee, it's a flat fee. Title insurance tends to be based on the amount of the loan. Escrows are in percentage terms. If I get, if I have a $200,000 house and the escrows are $150 a month for the taxes, they're going to set aside $150 a month for 9 months, let's say. On a $500,000 house, let's say it's $400 a month, they're going to set that aside. So that's basically is in line. But insurance, a $200,000 house is still going to have, because there's certain things, liability, et cetera, that are tied to an insurance policy. It's not going to get as expensive unless you have something fancy going on. They're not going to get a $200,000 house might have $50 a month, and a $400,000 house might be $65. So again, so there's both sides, but generally the cheaper the house is, if you're looking at a house at $100,000 loan, like a condo, your total closing costs are probably going to be between $7,000 and $8,000 for everything. If you're looking at a house that's, so there you go, it's 7 to 8%. Right. If you're talking about a house that's $300,000, depending on whether you're in PG County or Montgomery County, PG County taxes tend to be a little higher, so your escrows are $1,000 higher. You're probably looking at 3.5%. Okay. If you're looking at $500,000 house, you're probably looking at so 300 to 3.5%. At 500,000, you're probably looking at, again, about the same. Again, only because the transfer taxes get really expensive when you get past a certain price point, past 250. But yeah, I think that's fair. The cheaper, the less expensive. But you could use, just say, 3 to 5%. For a normal house in this area, 3 to 5% is safe.
Okay.
Yeah.
So even if I have a, zero money down loan, I still have to have some money to be able to to buy something.
No. No. You could be doing a down payment assistance, 3% down payment loan, and you can ask the seller for 3% in seller concessions. Zero down. You could put down $1,000 EMD, and that would be all you'd spend.
Right. Okay.
Yeah.
So,
it's most common with a VA loan to have nothing down. I actually did one. I closed a loan about 4 weeks ago, and it was down payment assistance and closing cost assistance. All they spent was the EMD.
Okay.
And the EMD was larger than what they needed to spend, so they got money back at the closing table.
Oh, wow.
Yeah.
Great. So we touched on those programs, the first time, the home buyer programs, the Home Ready and Home Possible. Are there any other state or federal programs to help low income or other specific disenfranchised groups?
Well, every jurisdiction has their own program. PG County has something that's a little bit different. There's a program that I don't participate in that's through Acorn that, again, it's a lot of time. You can't be in a hurry. You have to go through a counseling and they get you prepared. But the program is fantastic if you have the patience for it. There are things like that around. The ones that I participate in, are the Virginia program, the Maryland program, and the Montgomery County program. There's no time period. You just have to take a class online. You can be pre-approved very quickly. Trying to think what the barriers to entry are. I mean, other than not being on title to a home for 3 years and not making household over the limit.
Right.
That's really it. And of course being, first time home buyer.
Right.
I do quite a few first time home buyer loans in the course of a year. I do a lot of home ready loans. I do a lot of FHA loans. I do a lot of first time home buyer loans. Less standard conventional loans. That's probably the thing, what I do the least of. I do a lot of those through people moving outside. We're obviously adjacent to Leisure World, so I have a lot of retirees moving from their homes they've been in for a very long time into Leisure World, and they tend to be conventional loan buyers.
Okay. So to find out more information about some of the programs that you participate in, people can go to mmp.maryland.gov and
Correct.
HOC, which is Housing Opportunities Commission.
Commission, yes, hocmc.org.
Okay.
And just kind of play around with it. All the information is there. All the same things I'm going to tell you.
Right.
If you want to get a head start, that's where you go.
Okay.
It does list the income limits for each particular, like CDA says, income limits and purchase price limits for every county. Okay. Whereas HOC is obviously only one county, so it just has the limits for the different programs. So there is the down payment assistance rate. There's the no down payment assistance rate. Then if you work in Montgomery County, for example, there is an extra loan that you can get, which is like a 5% capped at $10,000 at 5% interest rate. And you pay it back $107 a month for 10 years, no prepayment penalty. But you have to work in the county to get that one.
Okay. So I guess the most important thing to say is everybody's situation is different. And the easiest way for people to find out, what they're going to be able to do is to come talk to you.
Right. So yeah, I get, again, I get every different kind of customer. The customers that say, I'm gonna leave this in your hands and trust that you're gonna lead me down the right path. I've never had anybody come back to me after the fact and say, you gave me really bad advice. You left me down the wrong path. I tend to know what makes the most sense, and my brain just starts ticking over the math of each different situation, and I pretty much know right away what the best situation is going to be for somebody. But on the flip side, I get the people that come in and just ask a million questions, and that's fine too.
Right.
So, yeah.
Okay. I know I've sent you people who, just from a credit standpoint, weren't yet prepared to be able to buy a house, and you've, been able to tell them what they needed to do to get there.
Right. Sometimes it's easy. Sometimes not so much.
Right.
It depends. Sometimes it's just a matter of paying off credit card balances. And sometimes you need to open, new accounts. Yes. And be current on them. And something as simple as that can get you a lot of points. Or you can have, you can be added to someone else's credit card who has good credit, and it will reflect on yours, even though that person doesn't have any risk. They can get you a credit card. You can charge something one time, but I mean, you don't have to charge anything.
Right.
So I've had situations like that where a person says, "Oh, that person doesn't want to do that." I'm like, well, there really isn't any risk. They obviously think there's a catch or something. There really isn't. You can get a credit card for somebody and take it from their hands. There's nothing they can do because you're the main borrower. So someone can't go behind your back and get a credit card in their own name. You could get them a credit card to help them with their credit and cut it up.
Right.
And never even give it to them. So that works too.
Yeah.
There's a lot of things you can do.
Um, are there things that you kind of see a lot that people come in with, and they didn't even know this was on their credit, and it's
Yeah,
they're
well,
pretty.
obviously credit card balances are a problem, but
Mm,
people confusion with student loan deferral and all of that.
uh,
Having a lot of late payments on several student loans at the same time, because that's what's happened. You'll have several payments and they'll all be late the first time, and it's devastating
uh,
to have. I see that a lot. So
yeah,
you're talking about large balance loans that are late, and these are devastating.
right. So get current on those.
The key is once you're done with the student loans, they're always in deferment until you're finished. Once you're finished, take them out of deferment into an income-based repayment plan, which will be a very reasonable payment, and then that's the payment we use instead of the default payment. I think people get overwhelmed by all the 10,000, 10,000, 10,000, 10,000, 10,000, and they each have a minimum of $100. You can consolidate them into a very small payment, and that's the payment that the lender will use,
Okay,
not all the other, not the required minimums that, let's say, your credit report shows.
great. Well, this has been super helpful, Chris. Thank you so much. And if people want to reach out to you, how do they do that?
My cell phone number is 301-873-0807. Feel free to text me and introduce yourself. I am busy, so sometimes I can't pick up the phone. I'm not ignoring you. Obviously, a text is easy because it's easy to respond and say, I'll call you at such and such a time. You can email me at CCAP as in Peter, O, N as in Nancy, I, T as in Thomas, I, at M as in Mary, O, A as in Apple, CC.com.
Okay. And I have this wonderful app on my
Yes,
phone.
even better.
Yeah. So I can share this with anyone who needs Chris's information. So you can get a hold of me as well, and I can just share his app with you. And this is great because it's got a mortgage calculator. So as you're walking around your open houses and stuff, you can actually kind of
Right.
figure out what your payment would be. Um, so again, thank you so much, Chris. I really
Thank
appreciate
you.
it. And hopefully this is really helpful for a lot of people.
Okay.
Thanks.
Take care. Have a good afternoon.